What if the secret to wealth isn't finding the next big thing? What if it's finding the most boring thing? Or the thing you're already buying every day? Or accepting that you have no idea what's coming next? 3 legends. 3 radically different philosophies. 1 result, consistent, massive success. Today, the masterclass begins. Welcome to MonsterInvest, the channel where we decode the strategies of the titans and turn their wisdom into your advantage. I'm your host, Eric. Today, we're doing something special. We're not just looking at charts. We're not just talking about P/E ratios. We are walking in the footsteps of giants. We are seeking the architects of modern financial thought. Think about it. In the grand, chaotic, often terrifying arena of the stock market, there are names that echo like legends. Warren Buffett. Peter Lynch. Ray Dalio. These aren't just rich men, they are philosophers. They are pattern seekers. They are, in their own way, storytellers. They saw the world, the economy, and human nature in a way that others simply did not. And the most fascinating part? They all reached the summit of the same mountain, while climbing completely different, almost opposing, faces. One climbed the face of pure, simple, patient value. Another climbed with relentless, on-the-ground curiosity. And the third built a machine to climb for him, designed to withstand any weather. So today, we're telling their stories. And through their stories, we'll uncover the timeless lessons they've taught us. This isn't just history, this is a masterclass in thinking. Let's start with the man who needs no introduction. The Oracle of Omaha. Warren Buffett. When you picture Warren Buffett, what do you see? You probably see an older gentleman, sitting in a modest office in Omaha, Nebraska, reading an annual report. He's not staring at a wall of blinking screens. He's famous for drinking cherry Coke and eating McDonald's for breakfast. And that, right there, is the first part of his story. Buffett's strategy is built on a foundation of profound, almost stubborn, simplicity. He learned from his mentor, Benjamin Graham, one of the most important allegories in finance, the story of Mr. Market. Graham said to imagine that you are partners in a private business with a man named Mr. Market. Every day, Mr. Market shows up at your door and offers to either buy your share of the business or sell you his share. The catch? Mr. Market is a manic depressive. Some days, he's euphoric. He sees nothing but a golden future, and he'll offer you a ridiculously high price for your share. Other days, he's in a deep, dark depression. He's terrified, and he'll offer to sell you his share for pennies on the dollar. The lesson? You don't have to listen to him. You can ignore him. You, as an investor, have the right to decide whether his price makes sense. You wait for him to show up in his depressed state, offering you a bargain, and you buy. And you ignore him completely when he's in his euphoric, overpriced mania. Buffett took this and built an empire. While the rest of Wall Street was chasing complicated derivatives and .com fantasies, Buffett was asking simple questions. Do I understand this business? Will people be drinking Coca-Cola in 20 years? Does this company have a durable competitive advantage, a moat? He tells a story not of timing the market, but of time in the market. His favorite holding period, as he says, is forever. Let's make this real. Imagine 2 investors in the late 1990s. Let's call them Sarah and David. Sarah is brilliant. She's reading all the tech blogs. She's on all the forums. She's caught up in the .com bubble. She invests all her money in a hot new company called Pets.com. The stock is soaring. She's checking her portfolio 20 times a day, her heart pounding. She feels like a genius. David, meanwhile, has been reading Buffett. He thinks, well, I don't really understand how these new internet companies make money. They don't seem to have any profits. But I do understand chewing gum. People have been chewing it for 100 years, and they'll probably be chewing it in another 100. So, he buys stock in Wrigley's. It's boring. His friends, like Sarah, are laughing at him. You're missing the new economy, David, they say. David isn't buying a stock ticker. He's buying a piece of a business that makes and sells chewing gum. And he's happy with that. He checks his portfolio maybe once a quarter. Then, the year 2000 hits. The bubble bursts. Mr. Market has a psychotic break. Pets.com, which never made a profit, goes to zero. Sarah's portfolio is wiped out. She's devastated. And David? Well, people are still buying juicy fruit. His boring stock is stable, it pays a dividend, and it continues to grow, year after year. David wasn't smarter than Sarah. He was just more disciplined. He was more rational. He followed the Buffett playbook: don't invest in what you don't understand. Demand a moat. And, most importantly, separate the price of a stock from the value of the business. The first lesson from Buffett isn't just about value, it's about patience. It's about winning a marathon, not a sprint. Now, let's travel from Omaha to Boston. Let's talk about our second legend, Peter Lynch. If Buffett is the oracle, Peter Lynch is the everyman. Lynch ran the Fidelity Magellan Fund from 1977 to 1990, and his record is, well, it's staggering. He averaged a 29.2% annual return. $1,000 invested with him in '77 would have been worth $28,000 by 1990. But here's the story. How did he do it? Lynch's philosophy was the opposite of sitting in an ivory tower. His core idea was simple: invest in what you know. He famously told the story of how he found one of his best investments. It wasn't from a complex algorithm. It was from his wife. His wife, Carolyn, came home one day and told him she had discovered this new brand of pantyhose at the grocery store. Legs. They came in these little plastic egg-shaped containers. She loved them. They were convenient, they were good quality, and they were flying off the shelves. Lynch, being Lynch, didn't just say, "That's nice, dear." He said, "Huh. Interesting." He became a detective. He went to the store. He saw what she was talking about. He did his homework on the company that made them, Hanes. He realized they had found a brilliant new way to sell a product directly in supermarkets, bypassing department stores. It was a whole new distribution channel. He invested. And Hanes became what he called a 10-bagger, a stock that goes up 10 times its original value. He loved finding 10-baggers. Lynch's story teaches us that you, the regular person, have an advantage over Wall Street. You are a consumer. You are a professional in your field. You encounter products and services every single day. Let's create another character. Let's call him Mark. Mark is a video game developer. In his spare time, he loves woodworking. He goes to the hardware store every weekend. He starts noticing that one brand of power tools, let's call it Rhino Tools, is always sold out. His friends in the woodworking forums are all raving about its new battery technology. The professional contractors are all switching to it. The Wall Street analyst, sitting in his New York office, just sees Rhino Tools as another tool company. He misses the buzz. He sees numbers, but not the story. But Mark sees it. He's on the ground floor. So, Mark does his Lynch homework. This is the crucial step. He doesn't just buy it. He goes online. He pulls up their balance sheet. He sees debt is low, but revenue is growing 30% year over year. He reads the annual report, and the CEO talks relentlessly about this new battery patent. It all clicks. The story he sees in the store and on the forums matches the numbers on the page. He invests. 5 years later, Rhino Tools has dominated the market and is a 15-bagger. But Lynch also gave a warning. He hated what he called diversification, buying stocks you don't understand in industries you know nothing about, just for the sake of being diversified. He said, owning stocks is like having children. Don't get involved with more than you can handle. Peter Lynch's lesson is that you don't need to find the next complex biotech firm. You just need to open your eyes and be a detective in your own life. The next 10-bagger might be the coffee shop you can't stop going to, the software your company just bought, or the pantyhose your wife loves. The lesson is observation, backed by homework. We've had patience from Buffett and observation from Lynch. Now, we need to talk about our third giant. This is a story of catastrophic failure and rebirth. The man who looks at the world as a machine. Ray Dalio. Dalio is different. He founded Bridgewater Associates, which became the largest hedge fund in the world. His story isn't about picking one or two great stocks. His story is about surviving. In the early 1980s, Dalio was a hotshot trader. He was convinced he knew what was coming. He made a huge, public bet that the global economy was heading for a depression. He was so confident, he testified before the U.S. Congress about it. And he was wrong. Completely, totally, painfully wrong. The market surged, and his bet imploded. He lost so much money, he had to borrow $4,000 from his dad just to pay his bills. He was broke. This failure became the defining moment of his life. It taught him a painful lesson. He, Ray Dalio, could not predict the future. His own ego was his worst enemy. His desire to be right was more dangerous than any market crash. So he asked a new question. Not, how can I be right, but how can I build a portfolio that does well even when I am wrong? He became obsessed with history. He studied every major economic boom and bust from the last 500 years. He saw that the economy is a machine with different gears. Sometimes, the growth gear is turning. Sometimes, the inflation gear is turning. Sometimes, the deflation gear is turning. This led him to his greatest discovery, which he calls the Holy Grail of investing. It's not a stock. It's not gold. It is radical diversification. But not the simple kind. He meant finding 15, 20, or more investments that are truly uncorrelated. Things that go up and down for different reasons. Imagine this. Let's take our final case study. Tom and Anna. Tom is an optimist. He believes technology is the future. So, his entire portfolio is in 5 big tech stocks. Apple, Google, Tesla, etc. He feels diversified. Anna is a Dalio follower. She says, I have no idea what the future holds. So she builds what Dalio calls an all-weather portfolio. It's designed to survive anything: high growth, low growth, high inflation, low inflation. Her portfolio looks weird to Tom. It's maybe 30% in stocks. But it's also 40% in long-term government bonds. 15% in intermediate-term bonds. 7.5% in gold. And 7.5% in other commodities. Tom says, Anna, why do you own so many bonds? That's crazy. Now, a crisis hits. Let's say, a sudden, unexpected spike in inflation. What happens to Tom? Inflation crushes tech stocks. Interest rates rise, and the future earnings of his companies are worth less. He panics. His portfolio is down 40%. What happens to Anna? Well, her stocks go down, just like Tom's. Her bonds also get hurt by the rising interest rates. But wait. What does well in high inflation? Gold. Her gold position spikes. What else? Commodities, oil, grain, metal. They spike. The different parts of her portfolio work like a team. The losses in one area are offset by the gains in another. Now let's say the crisis is the opposite, a 2008-style deflationary crash. Tom's tech stocks collapse. He's ruined. Anna's stocks collapse, too. Her commodities get crushed. But in a deflationary panic, what does everyone buy? Safe haven government bonds. Her 40% position in long-term bonds soars in value, acting like a giant airbag for her portfolio. She doesn't have the massive gains Tom had last year, but she also doesn't have the devastating loss. She is protected. She survives. She sleeps at night. Ray Dalio's lesson is humility. It's the wisdom to know that you don't know what's coming next, and the brilliance to build a system that doesn't care. So, let's pause. We've walked with 3 giants. What have we learned today? First, from Warren Buffett, we learned the power of patience. We learned to separate the chaotic price from the solid value. To wait for Mr. Market to offer us a bargain, and to have the discipline to hold wonderful businesses. Second, from Peter Lynch, we learned the power of observation and curiosity. We learned that our greatest investing edge is sitting right in front of us. To use our local knowledge, to be a detective in our own lives, and to do the homework to connect the story to the numbers. And third, from Ray Dalio, we learned the power of humility. We learn that the most dangerous thing in investing is our own ego. We learn to accept that we cannot predict the future, and that the Holy Grail is to build a truly diversified, uncorrelated portfolio that can weather any storm. Patience. Observation. Humility. These aren't just investing strategies. As Dalio himself would say, these are principles. They are, in fact, principles for a successful life. Thank you for joining me on MonsterInvest. Which of these three philosophies speaks to you the most? Are you a Buffett-style value investor, a Lynch-style observer, or a Dalio-style systems builder? Let us know in the comments on our YouTube channel. If you found value in this masterclass, please like, subscribe, and share this with someone who needs to hear it. Until next time, I'm Eric. Invest wisely.